She's going to talk a lot about that. And Kavitha, I turn the table to you.
Thank you, Lynn. Hey, everyone. So, a lot of people ask me, speak to a lot of investors every single day, and they ask me, hey, what should I be investing in? Should I invest in? What should I do? So, I wanted to kind of talk through today about how you want to adapt your investing strategy as we go through this crisis and also when we come out of this crisis, right? So, one of the things that I recently wrote a blog about this, and I will share the link with you as well. But one of the things I definitely wanted to cover today was what kind of market should you consider investing? I think it's a really important question when you start looking at what kind of markets, because there are two aspects to it, right? There is one where some markets we know are going to recover faster because of their some inherent conditions in those markets, and some markets are going to recover much slower. Today, I want to talk through some of those factors that affect the recovery of the markets, and I advise you to also follow a lot of economists who are talking through these. Like Mark Detzor is a great one to follow. Adam Kamins, he's from Moody's Reports. He's another great economist to follow because they're doing a lot of research, they're data crunching, and they're trying to figure out, okay, what are these factors that lead to a faster recovery? You not only want to worry about a faster recovery, but you also want your money to grow. So you want to look at the long-term growth potential of the market. So here are some of the factors that they have found influences the recovery of the market. So population density, let's talk about that one. We know that cities like New York or San Francisco, which have high density of population, are very affected now. We've seen the number of cases of COVID in New York. So they expect that unlike the 2008 recovery, we are going to actually have a slower uptake in the recovery in these markets. Whereas the lower the population density, those markets are going to recover faster, obviously, for the reasons that the spread of the infection are going to be lower in those markets. So we have a unique situation here we've really never had before. So we have to think out of the box here when we are doing our investments. The second factor is reliance on tourism and hospitality. Markets like Vegas and Orlando, which have a heavy reliance on tourism industry, are going to be affected in the near future because people are going to be worried about traveling to those places. So whether you're going for a conference in Vegas or you're going to Orlando, to Disney World, that's probably not going to be very popular in the next few months, or maybe even a year, depending on how long the treatment and the vaccine comes out. The third factor they have found, this was a bit of a surprise for me, is the educational attainment level. So the markets which have high level of educational attainment equate to white collar jobs. So as we can see, the white collar jobs are not very affected by this downturn because people are still able to work remotely. Whereas you take a market like Detroit, which has those blue collar jobs, they are very affected by by the COVID shutdown. So that is a third factor. So the combination of educational attainment, high educational attainment, and low population density actually leads to faster recovery of a market. And some of those names which have come up with experts are actually Austin, Texas. We are lucky to live in a place like this,
Yes.
and Durham, Raleigh, and a whole bunch of other cities. So if you want to see more details, you're welcome to look at the blog. The other factor is also the job and population growth in terms of the longer term growth, right? That's kind of what you want to look at. When there are new jobs being created and there's people moving in, and Texas, for example, has had a huge influx of people and continues to have a huge influx of people. So those are the kinds of markets that are going to do well in terms of returning the dollars, on your investment. You can go to the
Excellent.
next slide. So
I
this,
have to say, I really enjoy reading your blog related to that. So good point about, I've been getting call from New York, investor from New York trying to relocate to Texas. And also I've been getting a call from a broker who used to refer investor go to Orlando, Las Vegas. Now they leave all their investment Airbnb vacant. So, and you saw the news for Tesla coming to Texas, Austin. So definitely good article you have here.
you can go to the next slide. Okay. So I want to talk a little bit more than just the population density or the characteristic of the market. We already covered the point one now here earlier. So what are the other factors that I look at and I tell my investors to look at? So I wanted to share a little bit about that. So the second one is the asset class. So we know that just being through this, right? There are some asset classes which have been really hurt and some other asset classes are doing fine. When you think about it, let's say you are in the hospitality industry and you have all your eggs in that basket, you're probably really hurting right now. A lot of hotel operators are really strapped for cash, and we know that there's going to be a huge amount of foreclosures. So, but that will also mean that you have opportunities to buy there. So I wouldn't necessarily stay away from those asset classes, but just not at this time. For example, the other asset class that I'm very familiar with is multifamily. The way I look at it, it's a very stable asset class, and that's kind of what I'm looking for. Stability, the tenants are still paying in a lot of our Class B apartments and higher. The Class Cs are a little affected because they're the lowered economic demographic in terms of income. So when they don't get paid, they can't pay, right? Obviously. So we are looking at a lot of Class Bs, which are stable assets, and we're trying to acquire them for lower than market values right now and negotiating with the buyers, with the sellers. I'm sorry. So yeah, so there are still asset classes out there which are favorable to invest in. You just want to make sure that you're getting into the right asset class at the right time. So I would suggest, evaluating the asset class and figuring out, okay, how is it doing right now? What is the potential going forward to do well? The last one I want to mention is the risk profile. I think this is a time for us to be really prudent about taking on risks, right? You don't want to go into this high risk, high return scenario because you don't know how it's going to pan out. We still don't know what the trajectory of this recovery is going to look like. I mean, we have all sorts of guesses like, oh, it'll be a V, it'll be a swoosh, a Nike swoosh, and so on and so forth. But truly, nobody has a clue what they're saying, right? So I feel like right now is the time for us to just take on a little lower risk and be happy with conservative returns on your investment. And with that, I want to talk about what lower risk looks like, right? We have this property tax lien investment opportunity that we've been working on, that Lynn's been working on, and I have been looking at it with her as well. This is one of the characteristics of this opportunity. It's a very low risk opportunity because when you invest in real estate, you're at a highest lien position when you take on a tax lien. So that I consider the lowest risk because let's say we are lending 14% LTV on this particular tax lien investment, and you are in the highest position. Are you going to get paid? Probably, very good chance that you'll get paid, even if the borrower defaults on the payment. So we feel very comfortable with this position. The returns are not typically as good as, let's say, you could make 15-20% maybe in an equity-based investment. But this is more a debt investment, so returns are 8 to 10, which I think is amazing considering that what does the market do right now? A bank account pays a percentage, if that, right? So I look at it as it's great for principal preservation, but still great returns, and also gives you exposure to real estate with that low risk and avoid the stock market craziness. If anybody's been watching the stock market, it's been all over the place, right? Like one good news, it goes up, one bad news, it comes down.
Absolutely.
Just so unreliable.
Great summary, Kavitha. Give us good insights about the market, volatile market, and which one, how each market is performing differently. We, as Kavitha mentioned, we are working on this property tax lien fund opportunity. We actually are the part of a funding process right now. Any question on that? You want to know more information? Contact me, contact Kavitha after this meeting. Thank you. Go ahead.
Thank you, Lynn. So the last thing I want to talk about before I hand it off to Landon and Julie is the CARES Act. I want to alert all the investors to take advantage of what the CARES Act is providing us in terms of the provisions of the CARES Act that are very beneficial for our investing. So the first one's the retirement account leverage. So the retirement account provisions actually allow you to now take out penalty-free loans and disbursements from your retirement accounts so that you can create cash flow outside of your retirement account. I think this is especially important for businesses because a lot of businesses are strapped for cash flow. So instead of dipping into and taking loans, SBA loans are definitely available, but unless you're able to get hold of them, you have the short-term place that you can actually get your retirement account to work for you. Also, instead of taking a loan, you can also invest it, taking a loan for your business, you can actually invest it in other investments, which will make more than the loan will cost you, because you have to pay a very nominal amount on these retirement account loans, which is like 2%. So if you can take it from your retirement account and put it in an investment which makes 8 or 10%, that's a great arbitrage of your interest rates right there, right? So, Lillian, do you have anything to add there about retirement accounts?
No, I think it's a very good point. This is a kind of like a gift government is giving us as an investor. So we should take advantage of that.
Absolutely. And we are here to help you and guide you, and we can connect you with the right professionals who can actually help you set up your retirement accounts, establish, take loans, disbursements as you need, and guide you through the process. So we're here to help you. The second thing I want to talk about, which is again a very important aspect where you can get back a lot of the dollars that you paid even as early as 2014, is using the net operating losses in 2019 and 2020 to actually carry back those losses for 5 years prior. So 2014 to 2018, you can apply the net operating losses from 2019 and 2020. This is applicable if you're a real estate professional for tax purposes. And again, we are here to help you to see if you're qualified. And we will be, of course, working with your CPA, and we can work with you on this. The other one, which is also important for those of you who have invested in what qualifies as qualified improvement property, that I briefly want to mention because this is very important. Non-residential property was not eligible for bonus depreciation. That gave you a huge negative, K1 before. In 2017, when bonus depreciation came around in the Tax Cut and Jobs Act, also called TCJA, retail hotels, restaurants, and a couple of other investments were excluded from the bonus depreciation. Now they've actually put it into the CARES Act, and you can actually retroactively go back and do bonus depreciation on those items, which is huge because you could get back tax dollars that you paid before.
It is huge. Yeah.
Yeah. And also, if you have any net operating loss, if you don't have net operating losses in 2020, it's a great time to figure out how do you create that in 2020 and strategize with your CPA on that, so we can actually take that back and get back dollars from 5 years before. And as always with everything, we are here to help you. We are able to connect you with the right professionals to move you through this.
Lots of good information here, like Kavitha mentioned. We can talk over an hour for the advantage that this can bring to you. So let's chat with us offline. Okay, thank you, Kavitha.
Thank you, Lynn. Thank you all.